All right, stock was up earlier this morning. It's down as the overall market has fallen off today. Overall market's still up, but close to the flat line here. Here's the chart. Obviously pretty bullish. I'm looking offline here at some of the analysts and the street and this, that, and the other, and analysts are really bullish here. What I'm looking for is really to see if they have changed their guidance at all. Excuse me about that. Sorry. Everything I see here is upgrade. Obviously, from what we've seen in earnings here, it's really not what earnings are, but more what guidance is for many of these companies. Analysts, what do they say here? Again, I'm looking just to see if there's anything here that the company has come out and raised any sort of guidance or anything like that. Okay, might do. All right, let's take a look. So, what do you guys see here in CRM? Anything? What do you make of this chart? Yeah, I mean, it broke through, this last bit of resistance here. It has retraced a little bit here. I see nothing here, at least in terms of what we may see in the future. It certainly is in a bullish trend here. Again, the future of what it's going to happen on earnings is not necessarily what the earnings report is, but what guidance is. But we'll take a look at an iron condor here, but on the pullback today, this certainly might be something that I want to, maybe take a little bit of a long position ahead of earnings, which are after the close on Monday. Okay, stock is 162. Let me get the whiteboard going here. Stock is 162, and the expected move for next week, folks, is what? Okay, I think everybody's in the same boat. And Todd, what we do is we look at the expiration we're looking for, so next week, and it is a week out. Okay, and we look for the nearest, the closest at the money straddle, combination of the call and the put. So if we look at the 162.5 straddle right now, we can see the call and the put trading together is about $10.65. But of that, the stock is about 30 cents in the money from that straddle, right? The put is actually 30 cents in the money. So if we look at the 162.5 straddle was 1065 minus the 30 cents of intrinsic value. We get the straddle trading about $10.35, which is pretty close to what that expected move for next week is going to be. And I'm just looking over here at my Thinkorswim platform, and they have that move going out to next week of about 1070. So we're right in the ballpark. And remember, this is a move not to the earnings after the close on Monday. So for Tuesday morning, this is actually a move that we're measuring to the end of the week, the March 8th expiration. Okay, so the expected range then would be roughly 151 to 173. Everybody see that? Because TJ, what we want to do when we're measuring that is we want to take the amount of premium, okay, the amount of extrinsic value that is in the straddle. And if we're measuring the stock at, actually it was 160, let me change this here, 162.20, okay, and we're looking at the 162.5 straddle, then the put is 30 cents in the money, meaning there's 30 cents of intrinsic value. So the total value of that straddle then, which was $10.65, we reduce the intrinsic part of that, or the non-premium part of that, to get 1035. Does that make sense? Okay, so that's our expected range. Now let's go back to our chart here for a moment. Excuse me. And we already know that on the upside, there's really nothing up here, right? So if this thing's going to go, it's going to go pretty good. Downside, where is there any sort of support? I'd say the first line of support is actually down around the 50-day, which is not to 149. So support around 149 and really no resistance, just because we're all at, already at all-time highs. Good question. Good question, David. There is some there, but we're looking at support just right below here. That's $1 below the market. So I'm looking for something in the range of what that expected move is. You definitely could say that there is some support there, but I'm trying to find something down around that expected range area. But I would agree with you. They're definitely around 160-ish or so. There definitely is some short-term support there. Again, right now we're just kind of gathering information before we do the math to see what we might want to do based on reward to risk. Now, I would actually love to buy some deltas, get some upside exposure before earnings. Okay, because the stock tends to rally going into earnings. And with the stock down today, maybe that's an opportunity for us to buy some. So again, with the expected range that we saw for next week and the expected move, up around 173, maybe we look at, a 167 172.5 call spread right now. Now, the reward to risk on that is not going to necessarily fit into what we would really look for. Meaning, the 167.5, 172.5 call spread is $1.40. Okay, it's not bad, but the reward to risk on that would be 360 over 140. And for an earnings play, not quite enough. It's 2.57 to 1. It's not horrendous, but we really want to see that reward to risk on a straight directional vertical play closer to 3 to 1. Now, if we could buy this for $1.30, if the stock came down a little bit further, yep, I am, Len. Or even $1.25, absolutely. But here's what I'm thinking. Here's what I'm thinking on this one. Is if we want to buy some deltas, buy some upside ahead of earnings, and look for maybe a pop on Monday ahead of earnings, if we get that, we could turn this into a broken wing butterfly. Okay, if we get some sort of rally here, a little bit of rally, we could then sell the 172.5, 175 on Monday, and let's say we're able to get 40 cents even, maybe 50, hopefully more than that. Let's say we're able to get 50 cents. Okay. So this RR is a bit light right now, but if we do this with the intent to then sell the 172.5, 175 call spread on Monday, and create a broken wing fly, then what do we have? Okay, what if we're able to sell this next leg, if at 50 cents? What does that give us this broken wing fly for then? What pricing? Yeah, sure does. That is a pretty darn favorable reward to risk scenario. Really, really favorable. Again, this whole idea and this whole setup only works if we believe two things. One, that ultimately, obviously, the stock is going up on earnings. But two, if we want to get long, buy some deltas ahead of earnings. Right? Everybody can hear me, right? Okay. If we wanted a non-directional, David, we'd look for an iron condor, look for strangle swap. But someone had asked, maybe it was Dimitri earlier, someone asked earlier, what do you do if when volatility is in that mid-range, which it's not now, it's obviously extended. But what do you do when it's in that mid-range and you want to create something where there's no volatility risk, where something's Vega neutral? And I said, well, you can do a vertical, broken wing fly, that sort of thing. There's really not a lot of Vega risk here. There's only about a penny of Vega risk to this spread, which you can see here, right? Because we're trading like options. We're trading similar options. They do have delta differences to them. One is obviously quite greater than the other, but from a Vega perspective, a volatility perspective, the two are pretty similar. They're, penny to a penny and a half away. That's pretty much a Vega neutral trade. I haven't looked at that, Gus. I could. Yeah, Vega neutral. Butterflies are great. Iron condors are great. Ratio spreads, absolutely. To be Vega neutral. And we can discuss more of that. Okay, but I want to focus on this potential setup here for CRM. So I like this. I like the upside. I like the upside here with the intent that on Monday we might turn this into a broken wing fly. Hey, listen, if the stock were to rally, maybe we just take it off, right? And take some profits and leave. Okay, my other feeling here, though, is earnings are not until after the close on Monday. There's no need to rush into any potential setup right now. So even though I like this, I don't have to feel like, oh my God, I got to get in this right now. You know, I got to pay, oh no, it's up a nickel since we've started discussing it from $1.40 to $1.45. We have time on our side. We can wait. Now, if the stock continues to rally and it gets more expensive, okay, then maybe we missed out on an opportunity. But I'm willing to just throw out more of a lowball bid and let's see if the stock comes into that range. I mean, the stock today traded down as low as 159. Yes, it traded as high as 166, but it traded as low as 159. Michael, remember, it's not going to cost more to due to vol increase because it's a volatility neutral spread. So if one option changes due to volatility, the other option is going to change by the same amount. So the only thing that's going to make this more expensive on Monday is if the stock moves, not because of volatility. Okay, and Tim, you just need to populate all in the option chain here. You probably just have the March 15th. There are no March 19 options. They're all March 19 because that's the year. But you probably just have one or the other here populated. See what I'm doing here, Tim? Okay, good. Good. So, well, right, because like I just said before, Michael, the vega of each option is almost identical. So as one option changes, the other one is going to change. One's going to offset the other. They're a penny apart. And you can see that the implied vol is pretty much the same, almost identical on both of them, about 57%. If one moves, the other's going to move the commensurate amount because we're within the same expiration cycle. That wouldn't be true on a calendar, but because we're within the same expiration, they're going to move in tandem with one another. Okay, let's go through that, David. So I like, let me complete this here on the whiteboard. Then we would be in this for 90 cents. Now, let's look at an iron condor, completely neutral iron condor with no delta bias. No upside, no downside bias, okay? Just completely based on this expected move, this expected range to 151 and 173. So if we, believe that the stock is going to stay in that range, let's see what that iron condor is trading. Okay, so let's look at this and this here and evaluate this. So first off, I can tell you it's way too cheap for what we would want to do, for what our reward to risk is. Let's say this thing is trading $1. Okay, you can see the middle of the market here. Okay, let's say it's trading $1. Okay, let me put this on the board here. The 152.5, 150, and 172.5, 175 iron condor trading $1. That puts our break-evens at what prices? Market has now given up all of its gains from earlier today. Dow actually just went negative. Okay, what's the break evens on this, guys, at $1? What would that be? Anybody? Okay. Michael, thank you for answering. I don't agree with your answer, but thank you for answering. There we go, Roger. One side of that is right, Roger. Okay. Nope. Joe, come on, keep guessing here, guys. Jay, you got the upside. What about the downside? Ah, there we go. Tim, you are the first one with the correct answer. Tim is the only one that's got them both right on both sides here. How do we calculate that? It's the short strike plus or minus the credit we're receiving. So the short strike on the put side is the 152.5. So if we take the short strike minus our credit, gives us 151.5. And if we take the short strike on the upside, which is 172.5, and add the credit, so that is our break evens. Now, what we want to do is compare that break even to the expected move, expected range. Okay? To the downside, it's pretty close. It's not quite all the way there. Upside, it's just beyond, so that's good. Okay, so in terms of the break evens compared to the expected range, it's pretty good. They're in line. But if we're only able to get $1 on a $2.50 wide spread, then that reward to risk for us is awful. We want to get close to 50-50, close to 1-to-1 odds, meaning on a $2.50 wide spread, we would want to collect $1.25. So this is really, really not good. I would never do this. So David, that's how we go about evaluating this. Does that help you out? Does that make sense? We could also then look for a neutral type of spread. When you're looking neutral in terms of range bound, we could look at a strangle swap. Strangle swap, though, you're looking to take advantage of not just kind of the range bound move to one strike or the other, but also see if there's any volatility type of advantage to do that, volatility arbitrage. That's something we'll look at on Monday. Michael, this is all for March 8th. These are all March 8th options for next week, since earnings are on Monday after the close. You're welcome. All right, does that all make sense to everybody? So what I do like here, guys, is putting out that call spread. Buying that call spread ahead of earnings on Monday afternoon and making some adjustment potentially on Monday. But again, I am not going to force into this trade. No, Sam, what we would be doing right now is just buying the call spread with the intent on Monday to turn it into a broken wing fly. Don't want to do it as a broken wing fly right now because I'll put this up here. If we did it as a broken wing fly right now, okay, we're looking at maybe getting in at a buck 05. We have time. I want to work this thing. I want to get in at 90. Excuse me. Michael, I don't know what you mean by that. I honestly don't know what you mean by that. All right, guys. I am going to wrap this up. I will post the video in the room. I am going to put a signal out. I'm going to put a signal out on just the call spread part of this. Okay, now the stock has rallied since we have been discussing this, so we're not even going to be anywhere close to being able to buy this at 130. Stock is 163 now. If I put out a 130 bid, we're only going to get filled here if the stock drops back below 162-ish. Okay. Everybody understand? Okay, and Michael, I still do not understand what you were saying with your comment there. No, Roger. 140 was the price. I was saying I don't want to get in. I mean, I want this to come to me. I did use 140 on the whiteboard here, but there's no reason to rush into this. Right? Why do I have to rush into this? So I'm going to put this out there at 130. If we don't get filled, we don't get filled. I feel no rush whatsoever to get into this. Jules, there's nothing to cover. What would you like to know about Workday?